RMB internationalization is one of a number of key initiatives by China to liberalise its economy. This includes establishing the RMB as an international trade currency, investment currency and also reserve currency. There's no doubt that through these schemes China is seeking to allow capital to flow more freely over its borders. For the global investment community, this means that there's unprecedented access to China's markets. But secondly, with more two-way movement of capital more possible, there's more opportunity for different trading strategies. There's been perception at times that China is a more higher risk market, but I see this changing. For example, we're seeing FTSE include A shares in its emerging markets index. We're also seeing MSCI looking to do the same. So overall, I think the trend in the long term is that every well-diversified portfolio will actually include RMB denominated assets. Well, compared to other markets, China's operates very differently. By now everyone is aware of China having a different regulatory regime, but also different legal frameworks than other markets. Firms need to work through these challenges and levels of complexity very carefully. On an operational level, in particular, the sticking point seems to be around China's unique hybrid settlement cycle for equities. For Stock Connect, for example, pre-funding may be required on T-1. Shares need to settle within as little as a 4-day window on T+0, and cash doesn't actually settle until T+1. We know in particular this causes investors in other regions, and notably the US, considerable difficulty and also operational risk. So firms need to have their eyes wide open when they're looking at this market, and they need to review what processes they use and also what systems they have in place. DTCC currently is working very closely with regulators, we're working with exchanges, we're working with other infrastructure providers and at the firm level, both to identify and resolve some of these challenges, whether that's through adapting market practices or it's deploying best available technologies. I see a lot of upside. We're in the early days of something quite extraordinary. We haven't seen this before. China, through its Connect schemes and other initiatives, is bringing down its barriers. It's liberalising its trade flows at a very steady and measured way. Today it's Stock Connect, tomorrow it's potentially Bond Connect, a new access point to the world's third largest domestic bond market. It's not yet clear how it's going to work. Equity and bond markets trade very differently from one another. No doubt there will be further challenges, but I'm actually quite optimistic that through planning, industry coordination, and through the use of the right financial technologies, these can actually be overcome, and over time, volumes will grow.